Bull Bear Buzz podcast for decoding markets, fueling minds. Welcome, everyone. Today we're doing a deep dive into the recent earnings reports, Q4 FY25.
That's right. Focusing on three big names in Indian IT, TCS, Infosys, and Wipro.
We've got a bunch of financial news, analyst takes, basically trying to get a handle on where the sector is right now.
Yeah, and maybe where it's headed.
Yeah.
Especially with, the global economy being what it is. It's about cutting through the noise.
Finding the key signals. So let's jump right in, starting with TCS.
Sounds good. Tata Consultancy Services.
Okay, so their Q4 consolidated net profit, it dipped slightly, down 1.3% year on year, came in at 12,224 crore.
Right. And revenue was up, but only just 0.8% year on year to 64,479 crore. I think that was a little below what analysts were hoping for.
And EBIT was also down slightly, 0.4%. Margins slipped a bit too, about 30 basis points.
Yeah, down to 24.2%. But here's the interesting part. Their deal wins, the total contract value, or TCV.
That was strong, wasn't it? $12.2 billion.
Exactly, up 20% from the previous quarter. That's pretty significant. Plus, they announced a €30 per share dividend.
So, kind of a mixed bag. Muted results now, but strong future bookings. What's the story there?
Well, the management pointed to a couple of things. The ramp down of that big BSNL deal impacted the quarter's revenue. That makes sense.
Okay.
And they also mentioned softness in certain U.S. segments, consumer, retail, insurance, even auto.
And that's linked to the tariff worries over there.
That's what they suggested, yeah. Concerns about potential tariffs seem to be making some clients hesitate.
I see. So, navigating some headwinds currently. But the strong TCV suggests the pipeline is healthy.
That's the idea. It hints that maybe the demand for larger transformation projects is still there, even if immediate spending is cautious.
And what about their outlook?
Yeah.
Client budgets for FY26 expected to be flat. Discretionary spending paused.
Yeah, that's the cautious part. Budgets look flat, and those nice-to-have projects are being put off.
But management still thinks FY26 will be better overall than FY25, at least for international business.
They do. They're banking on those strong deal bookings converting and, the underlying need for tech upgrades eventually kicking in. They seemed, let's say, cautiously optimistic.
Okay. How are the analysts reading this sort of balancing act?
It's interesting. Antique Stockbroking actually upgraded TCS to a buy. They think the valuation looks appealing now, and they're projecting a growth pickup.
So, more positive there.
Yeah. And Sharkan also highlighted the strong order book and traction in AI and Gen AI as definite positives for FY26.
Even with a cautious environment.
Right. They acknowledge the caution, but still see positives, although they did trim their earnings per share estimates slightly for FY26 and FY27, just, reflecting that near-term uncertainty.
I kept the buy rating.
They kept the buy, yes.
Okay, so for our listeners, the key takeaway on TCS, Q4 was a bit muted, but keep an eye on that very strong order book. Management is cautious but hopeful for FY26, maybe driven by bigger tech transformations. It's nuanced.
Definitely nuanced. Now, shifting gears to Infosys, their story seems a bit different.
Yeah, their Q4 numbers looked weaker on the profit side, didn't they? Down nearly 12% year on year.
That's right. Net profit at 7,033 crore. It was actually up a little from the previous quarter, about 3%, but the year-on-year drop is quite stark.
And revenue? Up year on year, but down quarter on quarter.
Exactly. Revenue rose 7.9% year on year to 40,925 crore. But crucially, it dropped 2% compared to Q3 and 3.5% in constant currency terms. That miss versus estimates was quite significant.
Okay. But their margin was better than expected.
Yes, EBIT margin came in at 21%, which was a positive surprise. And their deal wins were $2.6 billion, lower than TCS's, clearly. They also announced a dividend, 22 per share.
Right. And the management commentary, that seemed to reflect the weaker revenue picture, especially the guidance.
Absolutely. They pinned the weak Q4 revenue partly on lower third-party revenues. And the guidance for FY26 revenue growth, that really caught people's attention.
0 to 3% growth. That's really low, isn't it?
It's their weakest guidance since, I think, April 2009. So yes, very conservative. Their margin guidance is stable, though, 20 to 22%.
What are they saying about achieving that guidance?
Well, management suggested the upper end, that 3% assumes a stable to marginally improving environment. So they're not counting on a big rebound.
Interesting.
What's also interesting is they expect sort of normal seasonality for Q1 without a major hit from the current macro uncertainties, which seems a bit different from what some others are suggesting.
Okay, a slightly different take there. What are the analysts saying about Infosys then? Weak numbers, weak guidance.
Generally, they're acknowledging the weakness. Nuvama kept a buy rating but did lower their target price. They basically said, look, Q4 was weak, guidance is soft, but we still have confidence in management navigating this.
Okay.
Motilal Oswal actually found the upper end of that guidance, the 3%, to be, quote, notably positive, which is an interesting perspective. Maybe seeing any potential growth is good news right now.
Right. Context is everything.
And most analysts seem to be making, minor tweaks to their forward estimates for FY26, FY27, just factoring in the current environment.
So the key point on Infosys for listeners, weaker revenue growth, quite cautious guidance signaling more near-term uncertainty than TCS perhaps, but stable margins and maybe a slightly more positive management tone on the longer term, despite the low guidance. Another complex picture.
Very much so. Which brings us to Wipro.
Right. Let's see how they fit in. Their Q4 net profit was actually up year on year.
Yes, up 6.6% to 3,588.1 crore. And revenue was also up slightly, 0.7% year on year to 22,445.3 crore.
Okay. And IT services EBIT?
Also up slightly, 0.7%. Margins were flat at 17.5%, so relatively steady on that front compared to the previous year.
But no dividend this quarter from Wipro.
No dividend declared for Q4, correct. And the management commentary, while they noted solid performance on landing large deals and executing on margins.
There was a definite but coming, wasn't there? A lot of caution.
Yeah, a very significant, but yes, definitely caution. They highlighted continued weakness in growth, lower average contract values, or ACVs.
So smaller deals on average.
Potentially, or just less value overall, and lower discretionary spending from clients. This all ties back to that macroeconomic uncertainty we've been talking about.
And their guidance reflected this caution quite strongly.
Extremely strongly. Their Q1 FY26 revenue guidance is for a decline of 1.5% to 3.5% quarter on quarter.
Wow, okay, a decline. That's a clear signal.
It really is. The outlook seems quite challenging. They specifically mention macroeconomic uncertainty and, again, those U.S. tariff policies possibly hitting client spending and causing project delays.
So how are analysts reacting to Wipro, given that avoidance especially?
The reactions seem the most reserved here. Nirmal Bang kept a hold rating. They pointed to the near-term weakness, the weak guidance, and basically said Wipro needs to show sustained growth recovery and really ramp up those large deals they've won.
Right, need to see execution.
Exactly. And Choice Broking went further, downgrading them to reduce. They cited the macro uncertainty, the tariff policies, and suggested Wipro really needs to lean on its AI and consulting strengths to turn things around.
Okay. So for Wipro, the key takeaway is probably the most cautious near-term outlook of the three. They're actually forecasting a revenue decline next quarter and seem quite concerned about the external economic climate hitting client spending hard.
That sums it up well. So, putting it all together, TCS, Infosys, Wipro, what's the overarching signal for the Indian IT sector right now?
Yeah, looking across the board, what's the big picture?
Well, the immediate picture from Q4 FY25 is muted. Earnings generally disappointed investors, it seems fair to say.
Lots of concerns about revenue growth, margins, the guidance.
Absolutely. And this shadow of potential U.S. tariffs, especially with potential political changes there, is clearly causing enterprises to rethink tech spending, maybe delay decisions. That came up repeatedly.
And the broader economic slowdown, sticky inflation, that's all feeding into it.
Definitely. It's creating a very cautious outlook. While there's maybe some hope FY26 could be slightly better than FY25, the consensus seems to be it's still going to be challenging.
Feels like the sector's at a bit of an inflection point, grappling with the economy, tariffs, and, of course, the rise of AI.
That's a good way to put it. An inflection point. Lots of moving parts.
We also heard from some other experts looking at the whole sector, right? What were they saying?
Yes. Their views really reinforce this cautious tone. Rajesh Sinha from Bonanza Group, for instance, he sees a challenging FY26, but thinks the long-term focus on digital, cloud, AI will eventually win out. But he flagged tariffs as a major near-term headwind.
Okay.
Then Punit Singhania at Master Trust Group, he also highlighted softening demand due to global uncertainty, macro headwinds, leading to cautious client spending. He used the phrase wait and watch for many user industries.
Makes sense. People holding back.
Exactly. And Prashant Taps from Meta Equities advised investors to be cautious, near to medium term, pointing to challenges in Western markets, tariffs, spending uncertainty. He basically suggested waiting for clearer signs of recovery in Western economies.
So the overall message for listeners seems pretty clear. Caution is the word for the Indian IT sector in the near future.
Yeah, I think that's unavoidable. External factors, potential tariffs, the global economy, they're creating real uncertainty for client spending and project timelines.
Long-term potential might still be there, driven by tech needs and AI, but the next few quarters look tricky to navigate.
Definitely tricky. So this deep dive really shows a sector facing some significant headwinds right now, doesn't it? Global economic jitters, potential policy shifts.
Yeah, and understanding these trends in these huge IT companies gives you, the listener, really valuable insight. It's not just about IT. It connects to broader economic forces, impacts on other industries.
Which leads to maybe a final thought for people to chew on. Given all this uncertainty and the huge potential but also disruption from AI, how do these IT giants need to adapt?
Right. It's not just about weathering the current storm.
Exactly. What bold moves might they need to make to not just survive the current climate, but actually capitalize on this changing tech landscape and secure real sustained growth in this new environment? Something to think about.